Here's what's coming up on Retiring Well with Michael Reese.
What happens with a surviving spouse is this. You die, your spouse is now a single taxpayer. If you're leaving her a huge IRA, she's taking income from a fully taxable asset at a point in her life where she's suddenly in super high tax bracket. Let's dive in and let's better understand how both mutual funds work and how the fees work, and then we'll compare that to exchange traded funds or ETFs, which are pretty much all the rage these days.
So when you look back now, hindsight being 2020, and you see that the markets have fallen to half their value now twice, right, with the tech bubble and the credit crash, what we're seeing is advisors doing nothing differently. They're positioning people the same way they did, before the 2000 crash and before the 2008 crash. That's what's scary.
And now the host of Retiring Well, Michael Reese.
Welcome to this week's show. Make sure you grab that cup of coffee and a pen and paper because we've got great information lined up for you this week. So don't go anywhere because Retiring Well starts right here, right now.
Hi, and welcome to this week's Retirement Roundtable, where I'm accompanied, of course, by Mike Reese, the founder of Centennial Wealth Advisory. And we have a very special guest with us today, Art Canfield, who's also an advisor in the office. Great to have you with us.
Thank you.
Hey, we've got a big topic today, Mike, and I think it's a little bit confusing, but we hear it all the time, and it's the term Roth, okay? So converting to Roth is our topic for today. Tell me more.
Oh, of course I will. First of all, Roth IRAs. Roth IRAs are all about our favorite two words on this show when it comes to retirement planning, tax-free, right? We love tax-free. It's like candy to a baby. And what a Roth IRA is in comparison to a regular IRA, so you've got an IRA, 401k, 403b, those plans, you get a tax deduction when the money goes in, the money grows tax deferred, but when do you pay the tax? At the end, when you pull money out. A Roth is a little bit like a mirror image. With a Roth, you pay tax on the money when it goes in. So it's after tax money goes in. From that point on, tax-free growth, tax-free distributions, with some exceptions, of course, but overwhelmingly general rule of thumb, tax-free. Now, what happens is a lot of people are saying, oh, well, I have these IRAs that I'm going to pay tax on later on. I really prefer a Roth IRA where it's all tax-free. The IRS allows you to, it's called convert an IRA to a Roth IRA. You simply pay tax in the amount you convert. So if you go $100,000 from your IRA into a Roth, you pay tax on $100,000 of income in that year. Once you've done that, the Roth IRA that's left over, tax-free for the rest of your life, provided you follow the rules.
So am I going to tax the seed or am I going to tax the harvest?
Exactly.
Right? And I'm sure there are very specific scenarios where that doesn't always work out. Sometimes you're better this way, sometimes you're better that way. Art, let me ask you, in the office, are you seeing a lot of people requesting this, or you see a lot of people doing this? What are your thoughts?
I think we see it all the time. There's a lot of questions on Roth IRAs. And remember, Mike's talking about conversions, not contributions here. And most common thing we hear somebody come in, they were rendered an opinion at some point in their life, typically when they were working. So they said, some accountant or advisor said, Roths don't make sense for you. You either make too much money or you're too old. Age is almost irrelevant when you're looking at it. It's more income based. And when you have to evaluate those options, it changes from year to year. Do you make the same amount of money every single year, especially in retirement? Probably not. So you really need to analyze that. And when we're looking through that and we're evaluating that, some people really appreciate the fact that it is a deep analysis done year to year.
And are there times where simply straight up, this is not a good idea to convert, and what might one of those scenarios be?
Absolutely. There's times, many times, that it's not a good idea, because think of this. Uncle Sam owns a piece of that pie, right? He owns some of that IRA. And if you that piece is too big of the IRA, it doesn't make sense to buy it out. When you have to look at it, what am I going to pay today, or what would I look at over time? The other piece of converting many people don't think about, Mike, is surviving spouse, right? We get into that all the time. It's not just for the married couple or the individual. You have to think ahead.
Yeah, that's a big deal, Mark, because what happens with the surviving spouse is this. You die, your spouse is now a single taxpayer. If you're leaving her a huge IRA, she's taking income from a fully taxable asset at a point in her life where she's suddenly in super high tax brackets. So you can't just look at the taxes that, a cost benefit on the taxes that you would pay as a couple. You got to think about the surviving spouse. And I'll tell you this is one of my pet peeves when it comes to Roth conversion. Do you know who does not want you to do a Roth conversion? The advisor you're working with. Or how about Vanguard or Fidelity or
See, I
Schwab?
thought you were going to say the IRS doesn't want you to do it.
The IRS would love to have you do it. Think about it this way.
Oh, they get their money earlier.
We have people we visit with all the time. They said, well, I was on Vanguard's website. I was on Fidelity's website, Schwab's website, and we did the analysis. And the analysis says that a Roth does not make sense, that a conversion does not make sense. Yet when we run the analysis, we come up with a very different opinion. Well, think about it. Does Vanguard want you to do a Roth conversion? Or does Schwab or Fidelity want you to do a Roth conversion when they know if you do it, you're going to take money away from them and they're not going to be paid on that anymore? They have an inherent conflict of interest when it comes to objectivity in that analysis. They don't take into account all the different levels of taxation like you talk about with a spouse. I mean, they don't. And so what happens is, or your financial advisor, they're not going to tell you to do a Roth conversion because that means a bunch of your money just went to the IRS. They're not getting paid. Your accountant has been trained from day one. Minimize tax today. That's all they care about. They don't care about down the road. So they're going to tell you, don't do a Roth conversion. It increases your taxes today. Yet, it's like a Band-Aid. When you have a Band-Aid, do you rip it off real fast? Or do you just peel it off a little bit at a time? Which way is better for you? Rip the darn thing off, right? Pay me now or pay me later. Oftentimes, not always, but oftentimes, a Roth conversion, it's ripping the Band-Aid off fast. And guess what? Art, how many clients do we have who have done big Roth conversions ever look back and say, boy, I wish I never done that?
Yeah, we've never heard somebody say, oh, I don't want that Roth IRA anymore, right?
Right, once they do it, it's like, wow, that was the best decision I ever made.
Very interesting. And Art, I'm going to have you wrap up this segment with telling me, and I know this would be sort of a broad brushstroke, but do the majority of people who are interested go ahead with it? Or is it kind of a 50-50? Or I know you have to look at each specific scenario. But for the most part, when someone comes in and they say, I have interest in that, is it a smart move to do it?
Yeah, it really comes back to that analysis. I would say the majority of people that when we show them on paper, here's what you're going to pay today, here's what it might be tomorrow, and if the benefit is doing it now, they're going to trust us and do it because it's going to save them money, both for them and their spouse potentially down the road.
Mike, Art, thanks so much. And if you want more information about converting to a Roth, give us a call in the office. Don't go anywhere. We'll be right back. You're watching Retiring Well with Michael Reese because your best is yet to come.
Life, a series of moments. A touch, a look, a laugh. Successful people. It might not be superior imagination. It just might be superior retirement planning. Imagine what's next. Plan today, own tomorrow.
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best is Yet to Come. Our very own Larry Flint will be the presenter. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The big three being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. Learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided and a spouse or guest may attend for free. The class will be held on 2 evenings for 3 hours each. Reserve your seats today by calling 231-995-1700. Again, that number is 231-995-1700. The class is called Retirement Secrets. We look forward to seeing you at our next event.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Welcome to this week's Coffee Talk. I am sitting here with Larry Flynn, one of the advisors in the office. How are you, Larry?
Great, Mike. Thank you.
Fantastic. We've got a great topic this week. We're talking about, Larry, how much you can safely withdraw from a portfolio. Because, you know, in the old days, right, you could pull, the rule was 4%. They had that 4% rule. And by the way, that simply means that when you're retired, you can pull 4% per year out of your portfolio, and your money should last for a lifetime, say 30 years. What about today, Larry? I mean, interest rates aren't the same as like they used to be, are they?
Yeah, no, Mike, that withdrawal rate really came out of the 80s and 90s, right? When markets were trending upward. And the idea was really not brain surgery. I mean, if I could get 5, 6, 7% every year and all I'm doing is pulling 4 or 5, that works all day long, right?
Yeah, you were showing me this a great graphic where, you know, 20 years ago, you could get bonds paying 7%.
That's right.
Right? And if all you have to do is take 4%, that works out real well.
That's right.
But bonds aren't really paying 7 anymore, are they?
That's right, that's right. Morningstar did an analysis, and where back in 1999 you could have a portfolio that had maybe 50% equity, 50% bonds, you could have a safe withdrawal rate be about 4%.
So this was, back in 99?
Back in 99. Since 2000 now, watching the market having crashed twice now, right? That safe withdrawal rate is now 1.7, I believe.
1.7?
Yeah,
So basically, let's call it 2%.
basically 2%.
So the old 4% rule is now the 2% rule? So correct me if I'm wrong, but could I not just take my money and put it under my mattress and at a 2% distribution rate have it last for 50 years?
Well, remember, not only are you taking 2% out of your portfolio, but with inflation,
Yeah,
right?
but still
eating
it's
that
going to
away,
last
too.
like 30, 40 years, right? There've got to be better answers. I mean, in the office, you've got to be able to deliver more than 2% income.
Yeah, yeah. If you structure a portfolio appropriately, you can get up to that 4 or 5%, but it's very important you structure it appropriately.
It's just different, isn't it?
It is.
You can't, it goes back to, it's a different world, right? It's a different world today.
Yep.
And you can't use the same tools today
right.
that you were using 20 years ago because you're not going to, just different world, different results.
Yeah.
Right? If you use
Yeah.
the same tools, you're going to get different results. So if you want to get that same 4 to 5% income, you got to do it a little differently.
Yeah. You
Right?
know what's scary though, Mike, is when you look back now, hindsight being 2020, and you see that the markets have fallen to half their value now twice, right, with the tech bubble and the credit crash. What we're seeing is advisors doing nothing differently. They're positioning people the same way they did, before the 2000 crash and before the 2008 crash. That's what's scary.
Yeah, I mean that's really important because as you're watching this, think about that for a minute. As you said very appropriately, these companies are recommending that all the folks at home here, they're building portfolios. They're telling them, here, build your retirement portfolio, and it looks exactly the same as what they would have recommended 20 years ago.
That's right.
Right? So if you were building a portfolio in 1995 and they're saying, here's the portfolio you should build today, they look the same, yet everything's changed.
That's right.
Right?
That's
Everything's
right.
changed. Are there what types of tools are you recommending people do differently? What are you telling people to do differently than they were doing 20 years ago?
Well, one, don't have all your eggs in one basket. If the best I can get is 2% by putting it all in equities and bonds, maybe I should be looking at other things, maybe some alternatives, you know. There's plenty of things out there, instruments that can be used to diversify an entire portfolio so you can get more consistent outcomes. Because the thing you're really trying to avoid is the big negatives.
Right.
You can deal with low return years, you can't deal with a 50% loss in the market.
Yeah, how do they say it? If I don't lose a bunch of money, I don't have to make a bunch of money to make up for the money I lost,
There you
right?
go. There you go.
Consistency wins the day.
There you go.
Well, thanks, Larry. That was great information. And folks, if you have any questions about this topic or anything else we talk about on the show, please feel free to give us a call or visit our website.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Hi, I'm Larry Flynn from Centennial Wealth Advisory, and I would like to invite you and a guest to enjoy a complimentary evening of food, fun, and information with me at our next financial education dinner event. We're going to discuss the important issues that could impact your portfolio and retirement. These topics include, can you protect and preserve your assets against market volatility? Can you prevent outliving your money? How do decisions in Washington, D.C. affect your retirement? How to make sure your current advisor is giving you the right advice. Can you find growth and security without risk in today's volatile market? Why getting a second opinion may be the most important financial decision of your life, and so much more. If you are a retiree or pre-retiree in Northern Michigan, then now is the time to take control of your retirement. Call us now. Seats are limited. I look forward to seeing you soon at our next dinner event.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
My tip this week is get a second opinion. Now think about this. Retirement, it's a fundamental shift in life. It is the time in life where you're not adding to the portfolio anymore. You don't have the time to make up for mistakes like you once had, nor do you have the resources. This is vital. Retirement, it's like 20 to 30 years of unemployment. You have to make sure you do it right the first time. Now, it's like a doctor's office. Let's say you have a serious medical condition. Are you going to take the first piece of advice you get, or are you going to get a second opinion? Of course, you always get a second opinion. Heck, you might get a third or fourth opinion. Well, retirement's like that. It is a very important time. At no other point in your financial life can a mistake have such a large impact. You have to make sure you're doing it absolutely right. So make sure you get that second opinion so that you are making good, smart choices for your financial future. If you have questions about this or anything else we talk about, by all means, give us a call or visit the website.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
Having no clear retirement plan is a mistake we see a lot in our financial planning office when we meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. If you don't have a clear retirement plan, call now and you'll receive a free complete retirement review. There's no obligations and no cost if you have at least $250,000 saved for retirement. Here's what you'll receive: a free report that tells you exactly what you are paying your money managers, both what you see and what you don't. a tailored plan to safeguard your investments from market volatility, a tax analysis to reduce liability and increase cash flow, and a custom income plan to boost your retirement. So call now for a free, no obligations, complete retirement review. And remember, you only retire once, so let's make sure you do it right the first time.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
This week in CFP Talk, we are talking about mutual funds and how they compare to exchange-traded funds. Specifically in how the fees work is where we're going to focus our attention today. Now, as you watch the show, you know, big pet peeve of mine is how, I love the financial industry, but, gosh darn it, why do we work so hard to hide what we're charging you? I believe it should be transparent. In our firm, our clients see everything. So, why do they have to hide stuff? I don't get it. In any event, let's dive in and let's better understand how both mutual funds work and how the fees work, and then we'll compare that to exchange-traded funds, or ETFs, which are pretty much all the rage these days. So let's start with ABC Mutual Fund, right? Very exciting name for mutual fund, isn't it? ABC Mutual Fund. And let's say this is the typical mutual fund out there, and you look up in the prospectus, and here's what it says. It says there's a management fee of 1%. Well, that's pretty typical in today's world. Management fee 1%, pretty standard stuff. Now, you dive in and you find, oh, look, this fund holds maybe 200 different stocks. And the thing that you need to understand, there's a ratio that you really want to know what it is. And, you might need Morningstar or something like that to look it up, but it's something called a TO ratio. That stands for turnover ratio. Pretty standard that it's somewhere around 50% in the industry. Some funds have a higher turnover ratio, some have a lower turnover ratio. It's important, though, you understand what that is. What it does is it tells you how many of those stocks are they holding how many of those stocks, if they hold 200 at the beginning of the year, how many of them do they still hold at the end of the year? In other words, how many did they sell and how many did they buy? So if the turnover ratio is 50%, what that tells you is over the course of the year, about half of these stocks were sold. So they are going to sell right around 100 of them, right? Right around 100 sells. And that means, though, they don't just leave the money in cash for the whole year, they also replace those with new stocks. So they'll buy another 100 positions. So they sold 100, they bought 100. That means over the course of the year, that would be about 200 transactions. Now, I have a kind of a crazy question for you. Do you think it's free to do all those transactions over the course of the year? Is it free for them just to buy and sell stocks whenever they feel like it? I mean, it's not. And think about it. It's not just the cost to buy and sell, because let's be honest, that's not a lot of money in today's world. Where the cost comes in is when you're dealing with these huge mutual funds. When they're selling a stock, they're not selling 10,000 shares. They're selling 1 million shares of stock. And what happens is when they're selling those 1 million shares, or when they're buying 1 million shares, that's enough that it's actually moving the market price in that position. And as a result, when they're selling, they're driving the price down. And so you end up selling at a lower price on average. That's a cost to you. When they're buying, they're driving the price up. Again, now you've got to buy at a higher price on average. That's a cost to you. And studies have been done out there, and here's what the studies say. They say that these transactions in a typical fund, they are costing you about 1.44% per year on average. So these are what are called, I'll put T, which means transaction costs. There's another cost that you often see, and we'll put it a C. What does a C stand for? It stands for cash drag. A lot of these funds are holding cash. When they sell these stocks or buy these stocks, they're not fully invested, they're holding cash positions. And those cash positions mean you're paying fees on this for money that's not invested. That's also a cost. Usually somewhere in the range of 0.83% or something along those lines. And it's very common that this fund that you thought was costing you 1% a year, when you add up all the expenses, it's really costing you more like, I guess if we do the math here, that's 3.27%. It can cost over 3%. There's a great article that Forbes put out that details this. Now, how does that compare to ETFs? Really pretty simple. With an exchange-traded fund, there is none of this turnover. It doesn't exist. They buy the positions, they hold it. There's no buys, there's no sells, there's no transaction costs, there's no cash costs. And by the way, you know what the fee is in these things? Not 1%, but normally it's only maybe 0.2%, if that. Lot cleaner way to hold a fund, lot cheaper way to hold a fund. This is why exchange traded funds, a big reason why they're all the rage these days. We're seeing mutual funds go away. We're seeing exchange traded funds become mainstream. This is a big part of why. Now, if you have any questions about this or anything else we talk about on the show, by all means, please pick up the phone, give us a call, or visit our website.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Hi, I'm Larry Flynn from Centennial Wealth Advisory, and I would like to invite you and a guest to enjoy a complimentary evening of food, fun, and information with me at our next financial education dinner event. We're going to discuss the important issues that could impact your portfolio and retirement. These topics include, can you protect and preserve your assets against market volatility? Can you prevent outliving your money? How do decisions in Washington, D.C. affect your retirement? How to make sure your current advisor is giving you the right advice. Can you find growth and security without risk in today's volatile market? Why getting a second opinion may be the most important financial decision of your life, and so much more. If you are a retiree or pre-retiree in Northern Michigan, then now is the time to take control of your retirement. Call us now. Seats are limited. I look forward to seeing you soon at our next dinner event.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Thanks for watching the show this week. And remember, if you have any questions, please feel free. Call us at the office or visit our website. Remember, you only want to retire once. Make sure you do it right the first time. We'll see you next week.